Hello, welcome to our classes. I am Dr. K.K. Misra. This is multiple choice questions MCQ on financial derivatives part 1. This is financial derivatives, in fact, is one of the papers in final semesters of MBA students of AKTU. This will be beneficial for those who have opted this as their specialized subject. Now directly come to the questions. Question number 1 dash risk is a loss may occur from the failure of another party to perform according to the terms of a contract. Options are A. Credit, B. Currency, C. Market, D. Liquidity. Correct option is A. Credit. Now question number 2. Financial derivatives includes. Options are A. Stock, B. Bonds, C. Future, D. None of these. Correct option is C. Future. Question number 3. By hedging a portfolio, a bank manager. Options are A. Reduces interest rate risk, B. Increases reinvestment risk, C. Increases exchange rate risk, D. None of these. Correct option is A. Reduces interest rate risk. Question number 4. A long contract requires that the investor. Options are A. Sell securities in the future, B. Buy securities in the future, C. Hedge in the future, D. Close out his position in the future. If you look at it comparatively, you will find B to be the correct answer, buy securities in the future. Now move to next slide. Question number 5. The disadvantage of swaps is that they. Options are A. Lack of liquidity, B. Suffer from default risk, C. Both A and B, D. B only. Correct option is C. Both A and B. Question number 6. Hedging by buying an option. Options are A. Limits gain, B. Limits losses, C. Limits gain and losses, D. Has no limit on losses. Correct option is B. Limits losses. Question number 7. All other things held constant, premium on options will increase when the. Options are A. Exercise price increases, B. Volatility of the underlying assets fails, C. Term to maturity increases, D. Both B and C. Correct option is C. Term to maturity increases. Move to next slide. Viewers, let me tell you that by and large the correct options are highlighted here. In case of any discrepancy found, that will be corrected in my narration. Now question number 8. An option allowing the owner to sell an asset at a future date is a. Options are A. Put option, B. Call option, C. Forward option, D. Future contract. Correct answer is A. Put option. Question number 9. Composite value of traded stocks group of secondary market is classified as. Options are A. Stock index, B. Primary index, C. Stock market index, D. Limited liability index. Correct option is C. Stock market index. Question number 10. Dash is the minimum amount which must be remained in a margin account. Options are A. Maintenance margin, B. Variation margin, C. Initial margin, D. None of these. Correct option is C. Initial margin. Now move to next slide. Let me tell you that if you like this video tutorial, if you find it fruitful, please do not forget to subscribe and press the bell button and forward it to many those who are in need of this type of content. Now question number 11. The number of future contract outstanding is called. options are A. Liquidity, B. Float, C. Volume, D. Turnover. Correct option is A. Liquidity. Question number 12. The amount paid for an option is the options are A. Strike price, B. Discount, C. Premium, D. Yield. Correct option is C. Premium. Question number 13. Futures contracts are more successful than interest rate forward contracts because they options are A. Are less liquid, B. Have greater default risk, C. Are more liquid, D. Have an interest rate tied to the discount rate. Correct option is C. Are more liquid. Question number 14. Financial derivatives include options are A. Stocks, B. Bonds, C. Futures, D. None of the above. Correct option is C. Futures. Question number 15. The payoffs for financial derivatives linked to options are A. Securities that will be issued in the future, B. The volatility of interest rates, C. Previously issued securities, D. None of the above. Correct option is C. Previously issued securities. Question number 16. Which of the following is not a problem with an interest rate forward contract? Options are A. Low interest rate, B. Default risk, C. Lack of liquidity, D. Finding a counterparty. Correct option is A. Low interest rate. Question number 17. Financial derivatives include options are A. Stocks, B. Bonds, C. Forward contracts, D. Both A and B are true. Correct option is C. Forward contracts. Question number 18. The payoffs for financial derivatives are linked to options are A. Securities that will be issued in the future, B. The volatility of interest rates, C. Previously issued securities, D. Government regulations specifying allowable rates of return, E. None of the above. Correct option is C. Previously issued securities. Question number 19. Which of the following is not a financial derivative? Options are A. Stock, B. Futures, C. Options, D. Forward contracts. Correct option is A. Stock. 20. By hedging a portfolio, a bank manager, options are A. Reduces interest rate risk, B. Increases investment risk, C. Increases exchange rate risk, D. Increases the profitability of gains. Correct option is A. Reduces interest rate risk. So this is all about this particular video tutorial. More quality questions will be given in my upcoming video tutorials. Thank you very much. Please like, share, and do not forget to subscribe and press the bell button and forward it to many. Thank you very much. Have a nice time. Best of luck.